Let's move now on to superannuation, and we're not going to do an exhaustive deep dive into superannuation. We've done some super stuff before, so check out the old previous episodes. But what I want to talk about is what's different in this tax year versus other tax years. So the first one, and the most important one, is this making a concessional tax deductible contribution before 30 June. Can you talk us through that and why it's important?
Right. Every year it's worth considering because you're moving the money from your marginal tax rate down to the 15% tax rate, assuming your income's not over 250,000. And of course it's locking it away in super, so you've got to be prepared to part with the money. But there's also this unused cap. So if in previous years you haven't used your full super, which was 25,000 and then went up to 27,500, anything you haven't used is just saved up for up to 5 years, and you can make that extra amount too. So if that's been accumulating there, you might want to think about, especially if you're in that 120 to that $135,000 bracket, you might want to consider using some of that as well to contribute in there, and just claim it as a tax deduction in your tax return. You get a nice refund back when it comes. But you've got to tell the super fund you're going to claim it as a tax deduction. And the key word is voluntary member contribution to get them to understand what you're trying to do.
And so just so I've got that right, Julie, what it's also meaning is that means that the total earnings that I get bring me down into that tax bracket. That's what you're talking about as well. Like it reduces the overall gross earnings of income because you've made that contribution into super?
Yes. Okay. So let me say you earned $130,000 for the year, and you take $10,000 of your after-tax dollars and put it into super, and you tell them that you're going to claim it as a tax deduction. So that $10,000 brings your income down to $120,000. So you, instead of paying 39 cents in the dollar by the time we add the Medicare levy on it, that you're going that $10,000 is going to give you a $3,900 refund, right? Because you've claimed a deduction for it. But instead, you've put the whole $10,000 into super, but there's only $1,500 that's going to be paying tax in there. So you got $8,500 working for you, whereas you would have only had $6,100 in take-home pay. That's what you were trying to get me to say, wasn't it? That take-home $6,000.
Yeah. So again, it's all about, so those tax ratios, those steps up in the 32 cents in the dollar and then 39 cents in the dollar, they matter, and so that's why that tax planning becomes quite important. And now, but I think it's really important to understand here that you are saying goodbye to that money to potentially 65 or maybe 67. When you say goodbye, it's going to accumulate in your super fund, and hopefully you get to see it in retirement. But that's the message that we've got here. So some of that little nuance of tax planning is really important. Now, there's lots of other sort of tax and superannuation planning work that you can do, but we were just going to highlight that one because it's relevant for this tax. The tax rate changes. I'm not using the right word, Julia. What do we call each of the different steps? The 32 cents. The brackets. Thank you. There's the word I was looking for. So the tax brackets. So when you're inside those different, that's where the planning becomes important. The other thing that we want to just quickly highlight on super, outside everything else is normal as we've talked about before. Check out the previous episode.